Stock Daily Insights. Your daily market compass.
Today, September the 10th, Tuesday, following last week's significant drop, the U.S. stock market showed signs of recovery, regaining some of the losses from last week. At the close, the Dow Jones was up by 1.2%, the S&P 500 increased by 1.16%, and the Nasdaq also rose by 1.16%. I'd love to hear your thoughts in the comments. Do you think we're about to see a sharp rebound, like the one at the beginning of August? Or was today just a brief rally before another downturn? As we discussed in last week's video, finding a clear answer isn't straightforward, so we continue to rely on technical analysis. Looking at the current trend of the S&P 500, the next key resistance point is around 5,500, with support near 5,380. For those looking to make short-term trades, these are critical levels to watch. A strong breakout above resistance or solid footing above support could signal a short-term buying opportunity. On the economic front, this week's focus will be on two inflation reports, which could further guide the Fed's interest rate decision next week. The Consumer Price Index, CPI, and the Producer Price Index, PPI, for August are scheduled to be released on Wednesday and Thursday morning, respectively. According to data from the CME, there's a high likelihood the Fed will cut rates by 25 basis points next week. A 50 basis point cut is possible, though less likely. Some economists are concerned that a 50 basis point cut might send a signal that the Fed is worried about a recession, especially at a time when market sentiment is fragile. Thus, a 25 basis point cut might be the most prudent move. Feel free to share your predictions in the comments. Do you think the Fed will opt for a 25 or 50 basis point cut, or will they hold rates steady? Today's market focus was naturally on Apple's event, although the company's stock price didn't show significant fluctuations. The event itself didn't present many surprises. It was more of a typical upgrade. Apple introduced the new iPhone 16, along with new models of its watches and earphones. The new iPhone's selling point is its AI capabilities, and Tim Cook emphasized that the iPhone 16 is built from scratch for AI, but these features will be gradually added in future software updates. In other words, the full suite of AI capabilities isn't ready yet. Apple's software head, Federighi, stated in his presentation that this is just the beginning. The first set of AI tools will be released as part of a beta test in October, with more features to follow in the coming months. The iPhone 16 and 16 Plus will feature minor upgrades in design and hardware, offering new colors and customizable control buttons on the higher-end models, along with more powerful chips and new camera controls that allow users to take photos and access camera functions more easily. Meanwhile, the new Pro models will boast slightly larger displays, thinner bezels, and run on the upgraded A18 Pro processor, with an enhanced neural engine for handling AI tasks. The Pro phones will have superior camera systems and video capabilities, enabling higher resolution photos and more cinematic slow-motion edits. So, in essence, Apple has painted a picture of numerous upcoming AI features, encouraging consumers to purchase the phones now in anticipation of these future enhancements. However, Apple's current AI efforts have been somewhat stumbling, with several delays, and many key features may not be released until next year. Currently, Apple's AI capabilities are limited to summarizing messages and notifications rather than the generative AI bots that competitors offer. Thus, whether the iPhone 16 will spark a new upgrade cycle largely depends on how compelling the forthcoming AI features are. If they fail to excite users, this update might be quickly overlooked. Now, switching gears to a broader economic topic, a significant event occurred in the markets last week. After 26 months, the 10-year Treasury yield exceeded the 2-year yield, effectively ending the notorious yield curve inversion. This inversion has traditionally been viewed as a precursor to a recession. Does its end indicate that a recession is completely off the table? Not necessarily. When the yield curve inverts, it suggests that investors expect inflation and growth to decline over an extended period. However, the end of this inversion due to expectations that the Fed will soon begin cutting rates has caused the 2-year yield to fall, thus unwinding the inversion. With recent weak economic data, particularly last week's non-farm payroll figures affirming this trend, the market is increasingly confident that the Fed will commence rate cuts, putting downward pressure on the 2-year yields. Market expectations for the federal funds rate by January 2025 have reached the lowest levels since February. Just a month ago, the July non-farm payroll data triggered bets on multiple rate cuts by the Fed. Despite some improvements since then, the market remains convinced that by January next year, the Fed's benchmark rate will drop below 4%. Looking further ahead, the market anticipates the Fed will cut rates at every meeting from now until the end of next year, reducing rates to around 3%, where they are expected to remain for a prolonged period. This reflects the market's view that the U.S. economy will experience a downturn between 2026 and 2027, necessitating the Fed to maintain lower interest rates to stimulate the economy. However, because of these reasons, there has been heightened anticipation for rate cuts. The 2-year Treasury yield has continued to fall recently, ending the long-standing inversion. In theory, the end of an economic downturn signal like this should be good news, but in practice, it's not that simple. Historical patterns show that while a yield curve inversion signals an impending recession, its end does not signify risk aversion, but rather that we are moving closer to a recession. Moreover, recessions do not usually occur immediately after an inversion ends. Rather, they tend to occur within 6 months to a year afterward. Naturally, we all hope to find reasons why this time might be different, and a recession might not happen, especially since recessions are not immediately triggered by the end of an inversion. However, the official arbiter of U.S. recessions, the National Bureau of Economic Research, NBER, typically announces the start of a recession 6 to 12 months after adjusting economic data, indicating that a recession might have already begun by the time it is officially declared. Thus, the end of an inversion could indeed be a significant sign that a recession is about to start. If we wait for an official announcement from the government, it's likely too late. By then, the recession would have been underway for some time, and the stock market would have already begun adjusting. In the chart, we can see this pattern clearly. The yellow triangles mark the official start dates of recessions announced by the government, while the blue lines indicate the economic shift from boom to recession, which typically occurs 6 months to a year earlier, exactly as described earlier. Also noticeable is that the stock market usually experiences a downturn between these 2 points, but the extent of each pullback varies, likely depending on the severity of the economic slowdown. This tells us that if the U.S. economy manages a soft landing, we shouldn't be overly concerned. Minor pullbacks could provide opportunities to buy into major stocks at lower prices. Additionally, it's crucial to understand that each end of a yield curve inversion and the start of a recession have occurred around the time the Fed begins cutting rates, which is not coincidental. The Fed usually cuts rates in response to slowing economic indicators, which tend to lag by several months. As these trends become clearer, the Fed may initiate more aggressive rate cuts to prevent the economy from slipping into a deeper recession. Because of this lag in data, while people may already feel changes in their daily lives, official figures might not yet reflect a dire economic situation. Does this mean that every time an inversion ends, the stock market will crash? Not necessarily. As shown in the graph, since 1990, excluding the economic slowdown caused by the COVID-19 pandemic, of the 4 times the yield curve inversion ended before a recession began, the stock market remained relatively stable 3 times, with downturns typically occurring after the recession officially starts, or near the government's announcement. This indicates that the end of a yield curve inversion is not a direct warning of an imminent major market pullback. Rather, it is more closely related to the onset of an economic recession, which directly impacts the stock market. But there's one issue we need to consider. This time is indeed different from the past. As this rate-cutting cycle begins, the market is more aggressive than ever before. Since 1990, each rate-cutting cycle was preceded by less aggressive market expectations than we see today. This suggests that the market believes the Federal Reserve needs to implement substantial policy stimuli to prevent a severe recession. Moreover, historically, each rate-cutting cycle has seen the market underestimate the degree of economic slowdown, so the actual rate cuts were often much more substantial than initially expected. Therefore, given that this time market predictions are far more aggressive than before, it could be that investors are overestimating the economic slowdown. Of course, we hope this is the case. If the market anticipates a recession but only a soft landing occurs, it would be the perfect outcome. The backbone of the U.S. economy is consumer spending, which is what we need to focus on most. Consumer sentiment will determine whether a recession occurs. Currently, the outlook for consumers is not optimistic. For instance, the expected delinquency rate, which is the probability that consumers anticipate they will be unable to repay their debts in the next 3 months, has risen again in August, reaching its highest level since April 2020. Additionally, U.S. consumer credit card debt continues to hit new highs while savings rates are dropping. Interestingly, despite poor economic conditions, U.S. households' expectations for future consumption have not decreased, but have continued to grow. This implies that they will rely further on credit cards for spending. Credit card debt has been climbing over the past decade, with U.S. households increasingly dependent on it. How long this trend can continue is unpredictable, but the rising debt burden may ultimately lead to a rupture. Although consumers' economic conditions are not optimistic, consumption has not stalled, but continues to increase. There may be several reasons behind this, such as the wealth effect from a strong stock market, or house prices, though retreating, still above pre-pandemic levels, pushing up consumer spending. While these are just speculations, the most important thing is that as long as consumer spending remains robust, the U.S. economy can stay stable. Faced with these changes, how should we retail investors act? First, this is definitely not a signal to sell everything. In the medium to long term, the outlook for U.S. stocks remains bright, especially with the advent of AI. Although valuations of related stocks are high, the impact of AI on the economy over the next 3 to 5 years will be very positive, significantly enhancing productivity across all sectors, which is one of the main drivers of GDP growth. However, the short-term reality of the market still exists. The market's primary concern is the slowdown of the U.S. economy. Whether it's the end of the yield curve inversion, or the various economic data we've seen, all signs point to the U.S. economy inevitably facing a challenge. The key is whether this challenge will be a soft or hard landing. Before the market finds answers, U.S. stocks will undoubtedly experience severe fluctuations. We need to stay vigilant, take appropriate profits on stocks that have already seen significant gains, keep sufficient cash on hand, and make a list of stocks we're long-term bullish on and plan specific actions. For instance, if you're bullish on Nvidia, you can set key support and resistance levels, and plan to buy in 3 stages depending on market trends. No one can buy at the lowest point, but we can reduce the risk of catching a falling knife through systematic technical analysis. Looking long-term, we are optimistic about the performance of U.S. stocks, but in the short term, we need to be more cautious and careful. Thank you for watching today's market update. For more insights and daily stock market analysis, don't forget to subscribe to our channel and turn on notifications. Share this video with others who might find it helpful, and leave your thoughts or questions in the comments below. See you in the next update.